Economic market overview. So, headwinds and tailwinds. Yes, everybody knows elevated interest rates, inflation, cost pressures. You investors have been much more cautious in your sentiment, lots of uncertainty, lots of volatility in the market, lots of headlines about multifamily. Certainly understandable to have an investor caution. However, there are some tailwinds. Transaction volume is expected to increase. Now, I would sort of put that in both categories. Sometimes we get our best deals when transaction volume is low and there's not a lot of buyers in the market, and we're able to get early looks at deal flow and find opportunities thanks to you all who still invest, buying when other people can't buy. As Warren Buffett likes to say, be greedy when others are fearful. Easy to say, not as easy to do. It takes investor confidence to do that, and I'll probably say that a few times tonight. Thank you to our investors for having the confidence to invest, especially in 2023, 2024. Demand is starting to outpace new supply. We'll talk about that more here. Drop in construction starts. Stabilizing rate outlook, we'll see. The rates have gone up, they've gone down, they've gone up, they've gone down. In fact, they've done it 16 times in the last 3 years, which is, you'd have to go back to the early 70s to see that type of volatility in the bond market, the rate market. And the Midwest is doing exactly what we hoped she would. She has been the steady Eddie, the tortoise versus the hare. Versus the national, more boom-bust markets, especially the Southeast, South Florida, Texas, Phoenix, Vegas. So from a year-over-year rent growth, Midwest has been one of the leaders in rent growth across the nation. We've had better occupancy, and our inventory picture is a big part of that. Yes, we've had more inventory, but it hasn't been quite as overbuilt as a lot of areas of the country, some of those cities I just mentioned. You can see there percentage of inventory. That is the number of new apartments that get built every year as a percentage of the total inventory of a market. So some markets, you'll see here in a minute, are way oversupplied. Indianapolis might have a little bit more supply than we'd like, but nothing quite like what we've seen in some of the boom and bust markets. And we're still very affordable rent to income. That is just how much of your gross pay goes into paying your rent. And that here in the Midwest is still quite a bit lower than it is in some of these other parts of the country. So The Rent Roll by Jay Parsons. Anybody know who Jay Parsons is besides people on my team? Fantastic, nationally known real estate economist. Good friend of mine, Tony Landa, is a big fan. Where's Tony? Our chief economist. There he is, straight from the horse's mouth, Jay Parsons. So this is a few slides he said I could borrow, but this is the national supply by quarter of apartments. That arrow is Q1 25. As you can see, anybody that's worried about overbuilding, starts, meaning putting a shovel in the ground, building a new apartment, is decreasing dramatically. This is one of my favorites. So this is starts versus completions, meaning how many apartments are being completed versus how many new apartments are starting construction. And we haven't seen it fall off a cliff like this. You'd have to go back as far as 1975. It fell quite a bit there, if you can see that, in 2008, 9, 10. But to go back as far as 1975 is where we've had this drop in new construction, which allows us to sort of see the future in what demand is going to be in the markets that we buy apartments. So this is multifamily. It's completed by year and forecast. So very similar to the slide you saw on new supply. But forecasting out a little bit into the future, these are completions. So these are units that will come online, they'll be rent ready, somebody can move into them. They're, as you would expect, falling pretty dramatically. This is actually one of my favorites. This is how far back do you have to go for a given market to when starts of new units were this low. So there's a lot of markets on here, but if you look, Indianapolis, Pittsburgh, we haven't been building this few units since 2010, so almost 15 years. And I bring up Indianapolis and Pittsburgh because those are markets we're in our current offering. And then Kansas City, there's Kansas City 2012, so almost as far back, over a decade since we were building this few units in the market. And meanwhile, population's growing and demand is growing in the markets we're in. This is demand. We did not see this coming. This is the first quarter of every year going all the way back to 2000. So this is just the first quarter, how many units were absorbed, meaning how many units came online, were absorbed by somebody signing a lease and moving in. And we had record absorption in the marketplace. One of the things driving this is the cost of owning a home, the cost of buying a home versus renting one is at an all-time high. The cost of buying is at an all-time high. And so you've just seen unprecedented demand for apartments. And then rent growth. So this is national. We are fortunate in the markets here in the Midwest. They've done what we thought they would do. They've exceeded rent growth. They've been rent growth leaders. But on a national level, you can see what happened, and it's going as far back as 23, and then it just falls off a cliff. In many markets, like I mentioned, the Phoenixes, the Vegases, Austin, Nashville, those markets are still experiencing negative rent growth. I think I've got a slide coming up here for that. But nationally speaking, you're starting to see rents tick up again, which is good for NOI, which is good for you all. This is a little bit harder to read, but basically, I'm going to try to explain this. Up and to the right is markets that have upward momentum and upward rent growth. So you don't want to be down left. Now you'll see Indianapolis, we're about 2% right now. We've got less momentum. But what you can see if you look really closely is Kansas City, way out there on the right, Pittsburgh just behind Kansas City as far as momentum of rent growth, meaning rent growth is increasing, and then how much rent growth that is. So I'm not going to belabor this too much, but this bodes very well for the assets that we bought in these markets versus, say, a San Antonio rallies on there, and then these other ones, Salt Lake City, Fort Lauderdale, West Palm Beach, some areas of South Florida that looked very hot up until recently and now are not. Jay gave me this slide. Basically, when should supply really drop below pre-COVID averages? So taking out the ginormous swings in the pendulum of all the things that COVID affected, when will supply go back to pre-COVID averages? So you see on there, Pittsburgh, very excited to be in that market. That is already starting to see the supply come back down, which bodes well for us and being able to raise rents. And then first half of 26 is where you've got Indianapolis and Kansas City, if you can't see that from where you're sitting. I think what's interesting on here is you see Austin is way, way over there. I remember a few years ago, an investor, I won't name you, was asking me if he should buy in Austin, Texas. And I said, please do not buy in Austin right now. It has proved to be a boom and bust market time and time again. This is one that excites me a lot. We've had wage growth outpacing rent growth. And you can see if you go back there in 19, they kind of follow each other a lot more in lockstep. Then COVID gets it all out of whack. But wage growth is really good for multifamily and for raising rents and investment performance in apartments. All right, so capital markets environments. If we look back to last year, around this time, rates are 4.65. Team did a really good job of watching the 10-year because it's moved so much. When they entered this in today, it was 4.30. I think I checked it last. It's still around 4.30. So we haven't really seen a lot of rate movement on an average, but we've seen just so much volatility. And that has definitely affected less on our ability to buy things, but more our ability to sell. If we want to sell something and then halfway into the due diligence process, the rate spikes, that can affect the buyer's capital stack, how much equity they've got to have versus debt. And it creates a lot of uncertainty in the market. People sit on their hands, which can be a great time to buy opportunities, but it makes it a tough market to sell in. I'm sure we'll talk a lot about that tonight. Elevated rates are the new normal. We certainly don't expect rates to go back down to anything like they were in COVID. And like I said, that's generated this gap between what sellers are willing to sell for. We'll get into that more, but maybe why we haven't sold things as much as we'd like the last couple years versus what people are willing to pay for them. So most of us who don't have to sell an asset are either in buy mode or wait mode. And then the Fed has dropped rates 75 basis points since we talked last year. This is a sentiment, large, medium, multifamily investors. Basically, do you expect to be a buyer, a seller? And lots of people want to enter the space. It scored the highest on asset allocation of investors with the 73, but capital is still really constrained. In fact, multifamily, if you look at this chart, it is just above office in investor sentiment around multifamily. So capital's been very constrained. Again, the opposite side of that coin is it's been a great opportunity for us to buy because of all the uncertainty. I mean, gosh, you look at that, like we're right next to office. So that doesn't happen very often.